The S&P closing at another all-time high, or closing at an all-time high, is another's not necessary, is it there, Jack?
It's
closing
helpful.
at an all-time. Why is it helpful?
Well, because I think.
Of course, it's another. It's not. It's an all-time high. You don't. It's.
When you make an all-time high every week, like we did
But
last year.
it is an all-time high. Jack Caffrey, equity portfolio manager, JPMorgan Asset Management. It seems that it reminds me again of a beach ball. Is there an environment being engendered by the new administration that just has some animal spirits flowing? Because I haven't seen anything on inflation or the Fed. Nothing stimulative to the stock market has really been happening, other than the possibility that maybe Doge works, or maybe taxes don't go up. What is it?
I think in the shorter term, people are excited about the prospect of less regulation.
I think that's it.
And from that, you look at what sectors have been working. Financials have been working fairly nicely. The idea that maybe they'll have less capital tied up. Maybe you'll get rid of some of the committees involved in how businesses are operated within the financial sector. You had the elimination of the head of the CFPB a week and a half ago,
right,
over the weekend. And so I do think that you are seeing some sense of maybe business will operate more efficiently going forward. Maybe government has the prospect of operating more efficiently going forward. And yet we still have to get to, well, what does this actually mean? Because at the same time, we'll have a tariff, we won't have a tariff.
That's the thing.
And so
Jeff,
I think we should separate between what people say. Are you more enthusiastic? Are you more optimistic?
Right.
When I arrived at the studio, you were interviewing Roger Ferguson about a CEO confidence survey. But let's see actually how their spending patterns evolve, not what they actually tell you.
But at this point, the market is acting like it wants to go higher based on fundamentals, which is no small feat when we hear every day, not necessarily just from legacy media, but chaos, end of democracy, tariffs, constitutional crisis. We hear all these things in the market. What is seizing on less regulation to where net it goes up, even though tariffs are supposedly so egregious to a free market? I would come back to earnings season is winding down, and we finally got the earnings season that I think we were anticipating through pretty much all of 2024. Earnings up 16%. You look within, and you actually saw that broadening out. You do see companies reinvesting in their businesses. And I think that is what most equity investors and traders are anchoring off of, because there's a lot of noise. There's not a lot of signal. I'll come back to earnings or the signal that are suggesting that companies are finding a way to operate in the environment, try to find a way to actually bring those sales to the bottom line, and ideally share those earnings with their investors in the form of dividends or buybacks. And you heard some of that out of Walmart right before I came here with a 13% dividend boost. Are you counting on rate cuts this year? I think that when you listen to the Fed, they are watchfully waiting to understand what the policy environment might look like. Do we need them for the market to keep going higher? If earnings go up, the multiple just needs to stay where it is, and you don't need a multiple expansion with lower rates, right? I mean, ultimately, given that valuations are high, I think we actually need earnings to really deliver to drive the market higher. I think valuations might be supported by rate cuts, but realistically, where rate cuts happen matter more. And I say that because when you think about larger investments, those are anchored off the 10-year. What happens to a mortgage at 7%? What happens with a fixed investment decision on where you locate your plant? Which, again, let's understand where the policy might be about who I'm trading with. What regions wind up being relatively favored or disfavored over the next several years. Versus the consumer, whose spending tends to be anchored off of short-term rates. So when Treasury Secretary recently offered some comments, well, we're not worried about pressuring the Fed to cut rates. We actually want to find a way to get the 10-year down. The 10-year has been fairly stable since that comment was offered. I think if you look within markets, yields have been stable-ish. The implied fixed income volatility in the MOVE index is moving along at sort of 52-week lows. But TIPS ETFs are looking a little bit overbought. We talk about new highs in gold. So I think you do see investors saying, maybe yield isn't the way to protect myself. Maybe I actually need some explicit inflation protection within my portfolios. I actually think equities are perhaps better equipped to be inflation protection than fixed income. But, when we say rates going down, which rates and how quickly and how long they can actually stay down.
Bottom line is we're in a bull market, and it continues this year, you think?
I think we're in a bull market. I think it continues. I think what we've seen over the last several decades is much longer and more modest durability of economic expansions, and those expansions can turn into earnings growth, and earnings growth turn into higher returns.
Right. All right, Jack.
Keep it simple.